So you have probably heard from many investors, hey, before you buy a stock, make sure you know what's the intrinsic value of the company. Or on the flip side, others will tell you that make sure to only buy stocks when it's undervalued. So naturally, as a new investor, in your mind you would be thinking, how the heck would I know what's the value of this specific company? So in this video, I'm gonna go through a specific model that is probably lauded as the gold standard of valuations in the investing world, called a discounted cash flow model. It acts as if like a medal that all the army generals wear. Just because you know the discounted cash flow model, it means that you're a good investor. I think contrary to popular belief, it's more important to really understand the mechanics and have a deeper appreciation of the model and what it spits out, rather than just going through the motion and follow it mechanically. So in this video, I'm just going to share my very simple framework and understanding of this model. And of course, for those of you who are interested, I'll leave the link to my simple model in the description box down below. But anyway, I think just diving into one specific example. So this is a DCF, a very simple one that I did for Alphabet, which is the parent company of Google, on the 14th of April 2024. Numbers might be outdated, but I think you should catch the drift. So simply put, I believe for all DCF models, you just need three specific inputs. Firstly, it's your growth estimates. Secondly, it's your exit, or in this case, terminal multiple. And lastly, which is your discount rate. In this case, it's this green box here that denotes WACC. So in essence, a discounted cash flow model is basically a projection of what you expect the business to produce in terms of free cash flow out into the foreseeable future, and then discounting it back to the present value. And after doing some simple manipulation, that's when you get all these different price targets and whether is it overvalued, undervalued, fairly valued, etc. And when you look across many of these different analysts from the different banks, you see each of them having a different price target. And then the first question that comes to mind would be, hey, aren't we all looking at the same company? How can we all derive a different value? So fundamentally, I think when you look into valuations, it's really both an art and a science. Science meaning it's quite mechanical because all of these formulas can be hard-coded in. And on that same note, it's also an art form because it really translates the story and the expectations of the particular analyst translated into numbers and then feeding it into this model to spit out an ultimate price target. Which is why different people with different expectations, different storyline, and different narrative will cough out a different price target. So right now, you might look at this spreadsheet and say that, why is it so simple? Why are there only two lines? These two lines specifically is cash from operations and capex, which is capital expenditure for short. So I think it really depends on how complicated you want this to be. So for myself, I like to keep things simple. And as the title suggests, it's a discounted cash flow model. So I just honestly have to know what's the free cash flow or the cash flow that's going to be generated in the foreseeable future and just discount it back. A lot of people like to go through the different nitty-gritties, try to project the different business arms, the revenue growth, the profit margins, the expenses, etc., etc. I think nothing wrong with that, but as you know, if more and more numbers get into the model, you tend to be more and more confused. So I rather just try to get the big picture understanding and appreciation of the valuations today, rather than really trying to drill down to one specific number and one specific price target. And I tend to include the historical performance of the particular stock to kind of give you a feel and a sense of this particular company. And on top of just sign up rewards and different campaigns that they run from time to time, Webull's in-house platform feature is nothing to sneeze at. So their in-house features have helped me expedite my own personal investment process. So when looking into a new company, some of us might just want a high-level understanding on the basics. So in Webull's app, you can click into the company section and it will provide you with an overview of the company's past financial figures, key indicators that you are looking out for, and even comparisons amongst their competitors in the same industry. So that allows you to assess their current market position. And this allows me to make the split decision on whether I should look into it further, and thus it has saved me a lot of time. So solid app experience, crazy sign up rewards. What more can I ask for? All the details to their campaigns will be in the link down below. Thank you Webull for sponsoring this video. So I think in this specific case, this is how Google grew their cash from operations over the last 6 years at a growth rate of roughly around 10, 12, 15%. There's a freak incident in 2021 and then it came back down in 2022. And on the capex growth side, you can see that it's kind of lumpy. It was on a downward trend from 2018 to 2020. It spiked up quite strongly in 2021 and 2022, and right now in 2023 it seems like it's just hovering right there. So I think moving into the projections, the first most important element, which is projecting out the future free cash flow. So free cash flow in a very simple terms is just cash from operations minus capital expenditure, which is why we have this third column, which is free cash flow, FCF for short. And when looking into 2024, I think most of these numbers don't really have to be estimated, because truth be told, the company tend to give some sort of a guidance from what they expect in terms of their revenue growth, in terms of their capex growth, not barring any existential or unforeseen circumstances like a global pandemic. So when looking into this, I think for 2024 figures, it should be fairly accurate. And some of you might ask, hey, so what about after 2024? 2025, 2026, 2027, what's going to happen? How are you going to get these numbers, or where are you getting these numbers from? Truth be told, for many people, they like to pull numbers out of their ass. But of course, there's definitely some sort of justification, because at the end of the day, it's your own personal model, and you really just have to model out your own narrative, your own story, and your own expectations. So for myself, how do I get the cash from operations figure? Truth be told, I just probably go into Seeking Alpha. I look at Alphabet, under earnings estimates. I look at what's the revenue estimates for the coming 3, 4, 5 years per se. And you look at the number of analysts, the more people following the stock, I think the more accurate the expected growth rate would be. And you can see that their top line revenue estimate for the out into the next 3 years, which has fairly many opinions on it. The objective view here is in 2024, they'll grow around 12%, 10% for the next 2 years. So which is why if you triangulate it together, that's basically my numbers, 12%, 10%, and then I flatline it to 8% in the following 3 years. And then you might ask, but cash from operations is different from revenue. Why are you using cash from operations, etc.? So which goes back to my main point on how do you specifically use a discounted cash flow model. I think a DCF really only focuses on companies that are pretty predictable and they have a proven business model and they have a long enough track record for you to compare, which is why these numbers are relatively stable compared to many smaller cap or maybe medium size or small to mid-sized companies that are still in that hockey stick phase where it still can experience historical amount of growth rates. And because of the explosive growth profile that many investors are looking forward to, maybe it's very hard for you to model into this simple Excel sheet itself. Secondly, also in terms of margins, because when we always look at the bottom line is always a percentage margin compared to the top line. And in this case, why am I able to use the revenue and then straight away convert to the growth rate for cash from operations? Simply put, because Alphabet, number one, is a fairly mature company, and number two, at least in my own storyline, I don't think Alphabet is going to experience a huge margin expansion or huge margin contraction, at least out into the next 5 years when translated down to their cash from operations. And I'll try to prove my point here. So historically, I have the last 6 years here from 2018 to 2023. When I go into their financials and pull their revenue, 2018 to 2023, I'm just going to pull out this 6 cell and just copy over here. So this is the revenue top line. And maybe I'll just put a reference here. So this is revenue. And when I divide the cash from operations to divide by the revenue, and I just apply it across the board, this is basically the cash from operations margins, if you guys can see it. And you can see that it's really hovering right there, 35, 34, 36, 32, 33. There is a slight dip in 2022. There was a lot of recessionary scares, which is why it's also reflected kind of in the share price itself. But likewise, if you are expecting this sort of margins to hold true with not a lot of deviation, that's kind of why I can just basically project the revenue down into the bottom line, which is the cash from operations as well. If you want to get to the free cash flow, you need the second part, which is capex. So capex, I believe for many of these tech companies, I grew it at a constant rate of 20% and then 10%. It's just my own projection. You can see that at least over the last 6 years or so, there is this up, down, left, right kind of maneuver. So I think it really boils down to how you postulate the future and the expectations of Google in this case. So this is the first part, which is growth expectations of the cash flow that are going to discount back. So the second part, which is the terminal multiple that you want to use here. So the first question from many new investors is, how am I going to get the free cash flow multiple? I don't know how much to pay. Is 10 too high? Is 15 too high? Is 20 too high? And how did you get to this conclusion that 20 to 24 is a fair valuation multiple? I think we can do it from two ways. One is on a relative approach and one is on an absolute approach. So on a relative approach, simply put, if you look at it from a historical perspective, many of these large companies have a long track record. And you can see I have put the free cash flow multiple of Google, or Alphabet in this case, over the last, 10 years or so. And you can see it's basically range bound between this range of 20 times to 40 times. Let's ignore this huge spike up because it was probably affected by the global pandemic. But if not, it's really very nicely trading in this 20 to 40 range. Why use 20? Why not 40? I think it's really the idea of how conservative or how aggressive you want to be. If you want to be conservative, you try to dial down the multiple because it means that investors are not happy or not excited to pay a high multiple for this company. Regardless of whether is it a business fundamental issue or maybe it's just a lack of excitement in the business or in the stock market in general. So the lower the number means the cheaper it is. The cheaper the exit multiple, meaning a vote of less confidence compared to you using a very aggressive assumption like maybe 30 times or 40 times. So I think if you really look at it, in order to be conservative, when you look across the last 10 years, trading at 20 times is a pretty fair multiple. I think there are a few times in Google's history that they were trading at 20 times. If you want to be even more conservative, you can even use 16 times. But I think 20 to 24 is pretty fair. At least this is my own perspective. So the second way of trying to find a fair multiple is really this idea of comparing the free cash flow yield versus other alternatives. It's basically the 10-year yield, which is what the US government is promising. So as you can see, over the last 2 years or so, the 10-year yield has spiked up from 1.5% to 4.6%. You might argue that 4.6% is actually the norm if you track back the last, 40 years. But at least over the last 2 decades, the yield was really much closer to between 1.5 to 2%. So you can argue until the cows come home on what is a fair yield, but this is what we are working with. It's either you use 2% or use 4%, which is the new normal. So how do you basically calculate what's the free cash flow yield of a particular company? Essentially, you just equals 1 divided by the terminal multiple that you wish to use. And in this case, let's say we are going to use a 24 times terminal multiple. And if you convert this to percentage term, this is basically 4.2%, which is actually trading at a premium compared to what the 10-year yield is trading at, which is the risk-free alternative. But let's also not forget the difference between an equity and a bond. A bond has no upside. They only promise you the coupon and you assume the default risk. Hopefully, in this case, the US government doesn't default and you just collect your coupon payment. But in this case, specifically for equities, businesses has this beauty of growing. So you don't mind paying 4.2% because maybe 5 years down the road, you are expecting them to maybe 1.5x their free cash flow. And in this case, if you 1.5x the free cash flow, everything stays constant, means that it goes up to 6%. I think this is just normal math. So this is the second way of you trying to value it. But in my own personal preference, I like to focus on two things. Firstly, it's of course the historical way. And secondly, it's of course my own expectations and how I foresee investors are willing to cough out a premium or not for this particular business. And if you realize, actually a lot of all these companies that are trading at a premium valuation, quote unquote, is because they really deliver monstrous growth. They deliver very stable financial ratios and metrics, and they are able to withstand many of these so-called recession scares. And despite all odds, they have a very sustainable recurring revenue. And because of this stability and predictability, investors are willing to pay up, which is why I arrived to this conclusion of a 20 to 24 times. So now we have two factors down, the growth rate and then the terminal multiple. Now the last one is really the discount rate. So simply put, after doing all these projections out into the next 5 years, you have to apply a discount rate to all this free cash flow because money today is worth more than money tomorrow, purely from an opportunity cost perspective. You can't expect $1 million in 10 years time to be worth the same as $1 million today. And let's also not forget inflation is definitely a killer. So the intuitive question is then, why discount at 10%? Why not discount at 8%, 12%, 15%? I think if you come from a very traditional finance background, the professors will definitely tell you to discount based on WACC. WACC actually means weighted average cost of capital. So as you know, different companies working in different industries, for example, an automobile company versus a tech company, will have vastly different debt to equity structure. So in order for you to really have a more fair comparison, you need to discount them based on their own weighted average cost of capital. So the WACC comprises of two parts. One is the cost of equity and one is the cost of debt. And because of the difference in terms of financing, in terms of how big this company is, what's the credit rating, how much equity is being financed, and what's the percentage, that's why this WACC figure is slightly different. But I believe for most companies out there, the WACC is probably between 7 to 12%, depending on which companies and what geography you are looking at. But anyhow, I tend to apply just a blanket 10% WACC. Number one is because it's the lazy way out. And number two, it's kind of my expected rate of return when I invest into a company as well. Because as you guys might know, if you invest into an S&P 500 index, they're expected to return a 7 to 10% over the long run. So 10% is at the higher bound. For those of you who want to be even more aggressive, you can even apply a 12% discount rate. I think it's really up to you. But I think the focus here is really the idea and for you to appreciate the utility of this discount rate rather than trying to focus on, oh, should I use 8.9%, 9% or 9.1%? And truth be told, a 1, 2, 3% delta will actually affect the stock price. But that's not really the focus here. Because I think generally speaking, if you really want to do a quick calculation, you want to do the lazy way out, you can basically just Google what is Google's or what is Alphabet's WACC. According to Alpha Spread, Alphabet's WACC is 8.66%. So by using a 10% discount rate, you're actually being more aggressive because the higher the number means the more aggressive your discounting is. So after that, after all this projection, voila, the model will essentially spit out a particular number or a particular price target. Of course, you have to input more details like what's the total outstanding shares, the share price today, the current market cap. So they basically just tabulate the present value of all future cash flow. And voila, that's your DCF in short. So like I've alluded previously, DCF is both a science and an art. Science being, because this is a very mathematical and a very mechanical approach, that's why it's very sciencey and people feel very grounded. They feel very safe that, oh, there's a number that I can look forward to. And if Alphabet is below 183, I think it's undervalued. But I think that's also not a very useful point of view because at the end of the day, these are just your own assumptions. So I think just 2 months ago, there were commotion around how Alphabet or Google's search business is going to be disrupted by all these large language models, specifically ChatGPT, Microsoft Bing. And if their cash from operations start flatlining or even go down and decrease, then all your expectations, there'll be a paradigm shift. And then Alphabet is no longer worth $183. And of course, you shouldn't look at this price target or this specific number as the be all and all, meaning that this number won't change. Anything underneath this means that it's undervalued because things do change, expectations do change, and storylines do change. So I'll give you an example. So let's look at Nvidia as a case study. You can see that back in 2022, at its peak, they were at $315 and they dropped more than 60% from November of 2021 to October of 2022. And some of you might ask, oh, what's happening? I thought Nvidia was this huge AI play. They were supplementing chips for most of these tech companies and it's basically the game changer. Sure, hindsight is 2020. Everybody know that it's a game changer. But if we were to just do a quick search in terms of Nvidia's numbers of what they delivered back in 2022, you can see that just in terms of their income statement, let's just do on a year-on-year growth rate. 2021, 2022, they were growing at monstrous amount, 50% year-on-year, 60% year-on-year, revenue top line. And then in 2023, it suddenly stopped growing at 0.22%. And similarly, just look at their net income profile. In 2023, it dipped by 55%. Earnings of a company, of this once-in-a-generation company, just 1-2 years ago, it was down 55%. And then people are asking, oh, why didn't you buy? In hindsight, they basically, I think, nearly 10x from peak to trough. Okay, maybe it's 7x, didn't 10x. So long story short, this model is just a translation of your expectations and your story of a company. It should remain fluid, and whenever you have new information coming in, you should adjust your model to kind of understand what the market is currently expecting. And if not, I hope you guys enjoyed this discussion, and I'll leave the link to this very simple model in the description box down below. And with that, I'll see you in the next video, but more importantly, I'll see you on the moon. Goodbye!